Can I let you know a secret? While I do not have a crystal ball, I do know that the stock market's going to crash. How do I know that the stock market's going to crash? Because it's a feature of the stock market. The stock market goes in cycles. There's periods of time it's undervalued. There's periods of time that it's overvalued. And unfortunately, when it comes to the overvaluation, the stock market tends to take the escalator up, but the elevator down. And actually, the term is it jumps out the window. So it goes down very quickly. So we have to be careful. So is the stock market going to crash? Yes, unfortunately, it is. It's just what happens with the stock market. Now, the question I don't know is when is the stock market going to crash? Is it going to crash in 12 months, 24 months, 5 years, 10 years? That I don't know. But in any given year, it's very common for the stock market to have a 10% correction and even a 20% correction from top to bottom during these cycles. So we want to be cautious. And right now, candidly, the stock market's pretty fairly valued, pretty highly valued. There's two indicators that I like to look at. One is famously called the Buffett indicator, which looks at the value of the U.S. stock market, the whole stock market, divided by our country's gross domestic product, GDP. And we are 2 standard deviations above the norm for that. The other indicator that I like to look at for valuation is called the CAPE ratio. Stick with me, it sounds complicated, but it's not. It's just a 10-year average of how much people are willing to pay for $1 of earnings. So many of us have heard of the PE ratio, the price to earning ratio. That is just how much people are willing to pay for $1 of earnings today. But if you take that over a 10-year period to kind of get out the noise, it was developed by a professor from Yale called Robert Shiller, and it's called the CAPE ratio, cyclically adjusted PE ratio. And that too is 2 standard deviations above its norm. So the market is definitely not cheap. Is it overvalued? I don't know. Historically, it sure isn't cheap, though. So what do we do? What does this mean? Given that we know at some point the stock market's going to crash, given that we know historically the stock market at least is not inexpensive. So what do we do? How do we make sure that we save our money so we can do trips like this, that our money is working harder for us? The reality is most of us, this is not financial advice. I don't know your situation, but for most of us, we need to have some exposure to the stock market in order to have our money growing at a rate at least equal to inflation, so our purchasing power tomorrow is at least as strong as what it is today. So how do we protect ourselves? Well, one of the things we want to avoid doing is being what I call a forced seller in a down market. And having been a financial advisor for over 20 years, my experience is there's 2 common ways that people become forced sellers in a down market. One is they need the money to live off of in retirements. And so they have to sell stocks in order to get money to live off. And the other one, and we'll talk about each, well, let me talk about the first one. So how do you protect yourself from that? Well, asset allocation is a great way to protect yourself from that. What percent of your portfolio is in stocks and what percent of your portfolio is in bonds? But instead of thinking percentages like 60% stocks, 40% bonds, 50-50, whatever the number is, I want you to think, how many years worth of living expenses do you have in stable, high quality, short duration bonds, high quality companies, good credit rating, bonds that are going to mature in 1, 2, 3, 4, maybe 5 years? How many years worth of living expenses do you have in that? So instead of being 50-50, let's say you have $1 million portfolio and you've got 500,000 in the stock market or 500,000 in bonds. I want you to think, how many years could I live off of, in this example, the 500,000 in bonds? So if you're spending $50,000 a year if you need that from your bond portfolio or from your portfolio. And on top of that, you've got Social Security. Maybe you've got a pension coming in from a previous job. So, in aggregate, maybe you're spending $80,000 a year. I don't know. I'm just making up numbers. But the important thing is you need $50,000 a year from your bond portfolio. Well, in this case, if you've got $500,000 worth of bonds, you have at least 10 years worth of living expenses that you can fund without having to sell stocks if they go down. And I think having at least 5 years worth of living expenses in retirement makes sense. I think more is better if, again, this isn't financial advice. If you can meet your financial goals, one of the tenets is take no more risk than what you need to achieve your goals. And the nice thing about becoming financially independent, the nice thing about saving up enough money to retire, is you only need to do that once. And once you've done that, then job number one becomes protect that nest egg. Don't lose that nest egg. You've already won. And don't change a winning situation into a losing situation. Don't give up something that matters, your financial independence, to gain something that doesn't matter. Okay, so that's the first way people become forced sellers in a down market. What's the other way? The other way is, frankly, just the pain that is caused psychologically by seeing your account go down when the market has a major correction. Again, if you have $1 million portfolio, let's just for easy math, say 500,000 if that's in stocks, and the stock market's down 20%, you just lost $100,000. And it's just human nature to think about how long did it take you to save your first $100,000. For most of us, it took a long, long time. In fact, if you save $10,000 a year and you get 7% on that in your investment portfolio, you're not going to get that in a bank account. $10,000 a year, it's going to take you 7.8 years to save your first $100,000, almost 8 years. And it's just human nature. If you were to lose $100,000 in the stock market, you would say, that took 8 years of sacrifice. That took 8 years of pain and getting up early every morning and commuting in order to save that. And that can take you from feeling uncomfortable to having angst. And the difference between being uncomfortable, being worried, and angst is a powerful word. Angst is something that, you can't sleep. You get this sick feeling in your stomach. And you want the pain to stop. So unfortunately, that is oftentimes what drives people to sell their stocks, unfortunately, oftentimes near the bottom and then lock in those losses. And a word of caution, unfortunately, once we retire, once we're no longer getting that monthly paycheck, the pain of loss increases, in my experience, having been a financial advisor and worked with hundreds of people. The pain of loss increases a lot. Not just 10 or 20%, but maybe 10 times as much. So how do you protect yourself? Again, it gets back to that asset allocation. When the market's high like it is now, when the market has done well for the last 2.5 years, this is a great time to look at your asset allocation and say, is this asset allocation right for it? And if I lost 20% in my equity positions, do the math. You got 500,000 in the stock market, that's $100,000 loss. You got $1 million, that's $200,000 loss. You really think about how's that going to feel if and when that happens. And the time to adjust your asset allocation is before the market corrects, because unfortunately, the market has a tendency to correct very quickly. A lot of people say, well, if the market starts going down, I'll sell. That'd be nice. It'd be great if we could do it, but the reality is few of us are going to be able to do it. So it's important to make good decisions on things like this. And it's also important to make the decision on when you retire, which is why I made this video here. Why waiting to 65 to retire might be a big mistake. I'll see you in that video. Thanks for watching this one. Bye-bye.